Hello, everyone, and welcome to today's webinar, COVID-19 Relief, What Federal Relief Offers Your Business. Today's webinar is going to be a recap, a review, a discussion of everything through Phase 4, not including Phase 4 relief, including really Phase 2 and 3, because Phase 1 relief didn't really contain any significant payroll provisions. It was mostly Phase 2 and Phase 3 relief, which did. And there's been, throughout the year, such a flurry of legislative activity, rulemaking activity, guidance, executive activity, frequently asked questions. It leaves us all dizzy if we weren't dizzy enough with the actual events that are happening around us. And what we're going to try to do in today's webinar is put some perspective from a bird's eye perspective, a bird's eye view on relief. I like to try to construct, when there's just so much information, to construct like a one-page summary of everything. And then I sometimes feel, and I tell people that I train and that I work with, just get everything down on one page, and then you kind of feel you have a handle on it. And then you can always drill down for further detail into any one of the items. So what I want to build with you here is kind of like a model of COVID-19 payroll legislation, phases 2 and 3, and make sure that we're all on the same page. You're not missing anything. There's no benefits that you had really not fully understood or not figured out how to take advantage of. So we'll drill down a little bit later in this webinar, but for now, let's just build the chart. So the first thing that happened payroll-wise was the FCRA, Families First Coronavirus Response Act. And that said that any employer with less than 500 employees has certain obligations and gets certain credits. And we'll talk about that soon. The 500 employee threshold is judged by a snapshot at the time that an employee wants to go out on leave, as opposed to some type of a look-back period. Now, after the FCRA came the CARES Act, Coronavirus Aid, Relief, and Economic Security Act, which contained additional provisions of relief that were further honed by yet further legislation. So first, let's start with FCRA. And remember, those employers who fluctuate around 500 employee thresholds may be having, some employees that are going to be covered under FCRA and some that are not covered under FCRA, because it's not a look-back period or a measurement period. It's 500 employees as judged by the exact time that an employee comes and says, well, I want to be covered. I'm claiming my FCRA rights. So what are those FCRA rights? So first of all, there's something called EPSLA, or the Emergency Paid Sick Leave Act. And that says that any employee who has to go out on sick leave gets a certain amount of paid sick leave. Now, this was a precedent when Congress passed this. The first time ever that there was paid sick leave on the federal level. And any amount that you, the employer, pay your employee for sick leave, you could then claim as a credit against your IRS deposit liability. So it wasn't really you paying the leave. It was more like the Department of the Treasury funding the leave. You were just the flow through which the money got to the employees. Any amounts that you paid were credits, but similarly, any amounts that you paid cannot be counted toward a PPP loan. We'll mention that later when we talk about CARES, but it's not counted as qualified expenses for PPP loan forgiveness. Just keep that in mind. We'll get into that more a little bit later. The second part of FCRA was often called Extended FMLA. You know how you have to give, Family and Medical Leave Act leave, which is usually not paid. For the first time ever, because of COVID, the federal government required paid family leave, not for all the same reasons as the emergency sick leave, but only if an employee has to take leave in order to care for a child due to COVID. We'll look at the reasons soon. And once again, that would be a credit. Anything that you, the employer, would pay would be a credit against your federal tax deposits and could not be counted as PPP payroll. Now, how much sick leave do you have to pay? Well, if the employee is taking off for self-care because they themselves have been affected by COVID, you pay them 80 hours at 100% of their pay, up to $511 a day for those 10 days, meaning up to a total of $5,110. The anything indicated here in red gets to be applied against your federal tax deposits. But if you pay more to your employees so that you've paid even more than your federal tax deposits, you can get your excess credits refunded to you via a new form called the Form 7200. And those of you who are interested in learning more about the 7200, we do have a recorded webinar that you can look up on the Viventium page and get more information about that 7200. Now, also under the sick leave, you're also required to pay employees who take off because of caring for others for certain qualified reasons that we'll take a look at. It's also 80 hours, but if it's other care, it's only up to 2/3 of their pay, and you only have to pay up to $200 a day, not $511. And so it's for 10 days, right? 80 hours, so it's a total of $2,000. And in some cases, if there's an employee who is, really crucial to your business, you may be able to get a case-by-case exemption. Under the child care leave or the extended FMLA, the paid, there you have to pay your employee 10 weeks of paid leave. Because remember, the first 2 weeks could have been covered under the other care provision, so they got those 2 weeks paid under the EPSLA, but the remaining 10 weeks are paid, again, only up to 2/3 of their pay with the same limits, $200 a day. Now, what about CARES? What did CARES do for us? CARES came along and said, first of all, you as the employer do not have to deposit your employer's Social Security taxes. You don't have to do it. You'll have to pay it eventually, but any taxes due after March 26th, meaning from March 27th and on through the end of the year, may be deferred in order to give you access to funds that you might need to keep yourselves afloat during this very difficult time. So you'll pay it to us eventually, but it's deferred. Half of it has to be paid by the end of 2021 and half by the end of 2022. CARES also said that you can claim a credit for wages that you pay to employees if you keep them on payroll, even though you don't have work for them. Let's say you were forced to close because of a government order or some type of other state legislation. You can't be doing the same level of business, and therefore you furloughed employees. Well, if you retain them on payroll, you keep paying them, well, any wages that were paid from March 13th and on through the end of the year, you can get a 50% credit for those wages. Again, the federal government will fund that payroll for you, up to $10,000 of wages per employee, meaning up to $5,000 of credits. And again, that can only be taken if you didn't take a small business association loan, if you didn't take an SBA loan, which is really the next part of CARES we'll talk about. There is a distinction between larger and smaller companies under the retention credit. Smaller companies can claim the credit even if the employees are still working. Larger companies only if the employees are not working. And finally, there is probably one of the most famous provisions of COVID, and that is the SBA Paycheck Protection Program, the PPP loan, where you were able to take out a loan for 2.5 times your average monthly payroll of last year, and you can get forgiveness for either 8 weeks or 24 weeks under the new extension. We'll talk about that, there was an extension. 60% of it has to be used for payroll, up to 40% can be used for certain other qualified costs, and anything that's not forgiven stays on the books at 1% for 5 years. So in a nutshell, there you have it, folks, one page of phase 2 and phase 3 COVID-19 payroll legislation. Now let's drill down a little bit. I had referred to the idea of paying sick for employees who are doing self-care as opposed to other care. Well, there are 6 reasons that you can take sick leave. The first 3 are dubbed self-care. You see here, whether you yourself are subject to quarantine, or you've been advised by a doctor to quarantine, or you have symptoms and are seeking a diagnosis, that's all called self-care. That's when you get to, when you, the employer, have to pay them up to 100% of their pay, and you have to only up to $511 a day, meaning you pay them 100% of their regular pay, limited to $511 a day. And the last 3 reasons, 4, 5, and 6, are if you're caring for an individual who is subject to a quarantine, or a child whose school closed, or any substantially similar conditions, which as of today, there haven't been any substantially similar conditions announced by HHS. Those are called other care, and those are only 2/3 of the pay, up to $200 a day. And of course, there's the child care, which is the 10 weeks, and there's only one reason that you have to pay 10 weeks to an employee, not for sick, not if they're out sick, only if they, at least not under federal law, only if they are caring for a child whose school or daycare was closed down due to COVID. It's not enough to pay your employees. A lot of employers overlook this. It's not enough to just pay them for their sick or for their family leave time. You must notify them of their rights. And here you have a copy with a link, actually, to the employee rights poster. Now, if your employees aren't coming into the office, it's sufficient to just email it to them or snail mail it to them or post it on a company website. But you do need to notify them of their rights. Otherwise, you have not fully met your FCRA obligations. And the CARES Act, well, the employee retention credit only applies to employers that have been closed or reduced because of COVID-19, which is most employers in the country, of course. You would have had to, or if it wasn't because of COVID, or at least directly, you weren't closed down, you weren't directly reduced, but you had a 50% decline in your gross receipts compared to the same quarter last year. The reduction doesn't mean that your main business operations have to be closed down. It could be some supplemental back office type of things, your mailroom, custodial services. Any type of reduction due to COVID at all would qualify you to take the employee retention credit. Of course, check with your tax advisor or your CPA before actually going ahead and changing any of your federal tax deposits. And the distinction that we mentioned last time, if you're a large employer, you can only get the credit if you continue paying employees who are not working. Smaller employers can get it for all employees who qualify. And even the health care that you pay to employees who are on retention or on sick leave or family leave for COVID for that matter, the employer costs also are part of the credit that you're entitled to. That's an important point. Again, employers tend to overlook that, but if you're continuing to pay health insurance premiums for employees who are out on FCRA sick leave or FCRA family leave, you can get credit for the health insurance premiums you pay as well. What if your deposits are not enough to cover all your credits? Like you've paid out so much FCRA leave for sick and for family, and you have so much retention credits, so many retention credits, and you have paid healthcare for all these people. It's not offset. You just don't have, even if you offset all your federal tax deposits and you don't send anything to the IRS, you still have more credits. How do you get it back? Well, the IRS introduced a new form called the 7200, and this is the form that you use to say, hello, IRS, I paid sick wages and I paid family leave wages and I have employees on retention credit and I paid health insurance for all these people and I offset it against my federal tax deposit and I still have more credits coming to me. Can you please send me a check for my advanced credits, for my remaining credits? That's Form 7200. And I'm not going to go into detail now. We do have on our webinar site at viventium.com a recorded webinar that you can listen to learn more about Form 7200. And then the employer deferral. I want to point out the third bullet point here is the way things were. And this is important. Not everybody realizes this. At the beginning, they said you can only defer your Social Security till the end of 2021 and the end of 2022 if your PPP loan was not yet forgiven. And then there was further legislation called the PPPFA, the Payroll Paycheck Protection Program Flexibility. FA stands for Flexibility Act, and that's extended and expanded the PPP. And one of the provisions there said, no, big X through bullet point number 3, even if your loan has been forgiven, you've gotten a forgiveness decision and it becomes a grant, you may still continue deferring your employer's Social Security through the end of 2020. That's important information for employers. And with the remaining couple minutes, I want to take a look with you at these PPP loans that have been so much a subject of public discussion and scrutiny and developments and changes. I want to focus on the qualified uses and forgiveness. The specifics of forgiveness, we actually have a separately recorded webinar that will step you through the forgiveness funds, the forgiveness application, so that you can figure out how your funds can become a grant. First of all, what can a PPP loan be used for? Well, it can be used for payroll costs, that includes benefits, and then 3 types of non-payroll costs: interest on mortgage obligations that were pre-existing February 15th, rent under lease agreements, and utilities. And further clarification issued said clearly that that would include transportation and internet costs. Now, exactly what type of transportation, there's even further guidance was issued about that on August 4th, and that specified which type of transportation costs are defined as utilities. For further information, I want to refer you to your tax advisor, your CPA, before making any financial decisions. Always consult with a qualified tax advisor. Now, when we say that you can use your PPP loan for qualified payroll costs, what does that mean? What are qualified payroll costs? The answer is it's salaries, wages, commissions, anything that you pay your employees, but only up to $100,000 on an annualized basis for your employees. So if you're using a period of 8 weeks for your loan or a period of 24 weeks for your loan, it would be the annualized portion. It would be the equivalent of an annualized $100,000. Benefits can include vacation leave, medical leave, sick leave, but not, as we said earlier, not anything paid under FCRA. Severance and termination pay also are included. And any type of health insurance premiums. For example, New York State employers, anything they pay under wage parity, if they're required to pay wage parity in the healthcare industry, that's fine, even if you're required under a different law, but anything that you're paying for health premiums for your employees can be counted toward your PPP forgiveness amounts, and there's not even any cap on that. That's outside of the $100,000 cap. Similarly, any retirement plans that you pay, matching contributions to your employees, those are also counted as qualified payroll costs. And your employer state and local taxes. Now that's only employer state and local taxes, again, not employee. Employee is already included there in the gross. That would be something like state unemployment taxes, if you have any occupational privilege taxes, if you're in that kind of a state, or any local municipal taxes that are paid based on your payroll, all of that counts toward turning your payroll loan into a grant. What are the requirements for forgiveness? Well, your costs have to be incurred and paid during the 8 weeks from the date that you first got your loan, not the date your loan was approved, but your date of disbursement. And that was changed and expanded under the PPPFA, the Flexibility Act, that said it doesn't have to be only 8 weeks. You can use 24 weeks. A lot of employers were saying, well, these 8 weeks, we were in the peak of COVID, we weren't operating, so you want us to just use up the loan by paying employees who aren't even working? What's going to be when our employees come back to work and we need help paying our employees? So Congress said, okay, we heard you, fine. We're giving you the option to use 24 weeks. Now, if your loan was made before June 5th, you can pick either 8 weeks or 24 weeks. If it was made after June 5th, then you would have to use 24 weeks, but that's usually to an employer's advantage. You can use up to 60% for payroll, but not more than 60% of payroll will be forgiven, meaning you can use more than 60% for payroll. You can use 100% for payroll and it will all be forgiven, but not in the other direction. If you use only 50% for payroll and 50% for those non-payroll costs that we mentioned before, then you're not going to get full forgiveness. Your forgiveness is going to be reduced. You're only going to get forgiveness you're only going to get full forgiveness if 60% or more is used for payroll. Important point there. And those of you who join us for our explanation of the 3508, which is the forgiveness form, will see how that actually plays out on the form. And you can't go ahead and prepay your mortgage interest and say, oh, wow, this is great. I have 24 weeks to prepay my, mortgage interest for the whole year or something. So it specifically says you can't go ahead and do that. Important. What do you need to track and retain to prove that this PPP loan was actually bona fide and used properly? So for your 8-week or your 24-week period, you want to make sure to be tracking your check registers, your employee earnings records, your government forms, 941, 7200, your state and local tax forms that show how much was paid for employer tax. And in order to request forgiveness, you want to make sure that your payroll provider can provide to you, as the Vent team does, the list of your full-time equivalents. These are concepts that are on the form. We explain more in our other webinar. The pay rates that employees have been paid, because if you don't maintain your pay rates to your employees, if you reduce their pay, you may be subject to forgiveness reduction. And of course, any documentation of your eligible mortgage, lease, and utility information. A quick peek at the form. This is it. It's called the Form 3508. It's the PPP Loan Forgiveness Calculation Form. For those who had more simple situations, they would be able to use the 3508EZ, which is a one-page form. The 3508 itself is basically a four-page form. 3508 is just a one page and a second page of certifications. That's the EZ. So depending on where you if you could fall into, which category you fall into, you may be able to use a simpler form. More about that when we do a special webinar that on the 3508 and the 3508 EZ specifically. And so we've reached our time limit for today, and I want to thank you all very much for joining us for this review, refresher perhaps for some, overview for others, and hopefully enlightening for everyone of Phase 2 and Phase 3 COVID relief. And I want to invite you to visit us at viventium.com, especially our COVID-19 solutions page, to learn more about how Viventium can help you and your business weather COVID-19. Thank you very much and have a great day.